Good morning, you're watching Market Cafe on ET Now with me Shreyansi Singh and Kanishka Sarkar, and over the next 1 hour we'll get you updates from within the country as well as across the globe, tell you which stocks you should be keeping on your radar and tell you what the brokerages in fact are saying bright and early this morning. But tell you what, this morning is starting on a very somber note because we do have spine-chilling updates coming in from Pahalgam. At least 26 people were killed by terrorists in J&K's Pahalgam. Among the victims of the terror attack are at least 2 foreign nationals, one from Nepal and another one from UAE. At least 5 people who were injured are hospitalized at this point. The army, in fact, has issued a statement informing that the search operation to hunt down terrorists is still underway. Meanwhile, you do have PM Modi, who's also decided to cut short his Saudi trip, and Finance Minister Sitaraman also returning from Peru to review the security situation at this point. A cabinet committee on security meeting could be held. Home Minister Amit Shah also rushed to Srinagar last evening, is expected to return to Delhi by evening to attend the crucial security review meeting. High alert, in fact, has been sounded when it comes to Delhi and Mumbai. And those are the latest updates. In fact, on that note, let's also go across and listen in to some reactions then coming in from the defense experts and what they then had to say about this incident which took place in Pahalgam yesterday.
Yes, this is a targeted attack, and this is very much an attack to shoo away the tourists from Kashmir with a view to prove to the world that all is not well in Kashmir. However, this incident is not going to, produce the result which Pakistanis or their handlers across the border are wanting to achieve. This is a terrorist targeted attack. As you said, they were bifurcating or they were dividing people, segregating people in the name of their religion or their names. So it is the targeted attack. But they have not targeted a tourist. What they targeted is the livelihood of a common Kashmiri people. Kashmiri people had started earning well because of the tourists coming, the poniwalas, the sumowalas, the artifice, namda, gaba, carpets, the carpet weaving, the furniture shops, paper mache. All these people had started to make a good livelihood. The schools had opened, the children had started going to the schools. Now with this type of attack, which is a direct result of diverting attention away from internal problems of Pakistan, especially after the freedom fighters attacked the train in Balochistan. There are a lot of rumbling and there are a lot of noise against the Pakistan security establishment and their chief speaking against the religions of people who are part of his army. Against their religions also, he's making a statement which was unheard of by any military commander in the world. Now, all this combined together, they wanted to prove to the world that Kashmir is not a safe place yet. But in today's internet world, today's world of social media, their lies would be known to everyone by the visuals which they would see on social media. And other aspect was they have probably timed it with the US Vice President's visit to India and Indian Prime Minister's visit to Jeddah, so that those visits get overshadowed by this terrorist attack. But everyone knows that terrorism is coming from Pakistan. In fact, by this, Pakistan is exposing itself more than trying to expose the weaknesses in the Indian security system or Kashmir's peace.
Pakistan Army's identity is based on Kashmir. If the Kashmir problem is finished, the Pakistan people ask Army, what are you doing? They came in Army uniform. Then they approached the tourists. Tum Hindu hai, Muslim, kya naam hai tumhara? The moment he found out he's Hindu, he shot them. That's how they killed 2 or 3 now and so many injured. That's what they're doing. This is going to affect the economic the development of the whole thing. But tourism will stop. After this incident, you'll see the drop in tourism. And that is what is happening.
This cowardly act is for a purpose with a design, basically to create terror. And it's a very rare that they attack the tourist. This time they have attacked the tourist. So it is to prevent the tourists to come to Valley. That may be, but it will be very, very unethical against the local population of J&K. Of course, it is also to send a message to the world because the Vice President of USA is here at present in India to send a message that the things are not normal. and thirdly, to raise the morale of the Pakistan army, which is at the lowest ebb. I am sure the armed forces are on high alert. They were already on high alert. One, this type of action is taken. Our immediate aim will be to nab these terrorists. And secondly, of course, we will send a strong message to Pakistan. You dare not do these things.
Well, very distressing developments coming in from the valley. While we'll keep you updated with the latest developments that are coming from Kashmir's Pahalgam, let's also go across and check out the handover that we got from the Wall Street overnight. Well, US stocks came off a winning session with the Dow surging more than 1,000 points to end a 4-day losing streak. Both the S&P 500 and Nasdaq Composite jumped more than 2.5%. Now, this rally comes at a time when Trump has said he has no intention of firing Federal Reserve Chair Jerome Powell, whose term as Fed Chair is due to end in May 2026. Now, remember, this comment is a reversal of sorts for the US president, who fired off barbs against Powell as recently as Monday, calling the central bank leader a major loser. And he also demanded that interest rates be brought down immediately. Well, apart from those remarks and gains on the back of earnings, what also aided the sentiment were comments from Treasury Secretary Scott Bessent, who hinted at the possibility of de-escalation in Trump's trade war. In fact, he mentioned to a group of investors in a closed-door meeting that no one thinks that the current status quo is sustainable. Now, these comments seem to have soothed investors' worries around trade policy tensions. Meanwhile, Trump has also indicated that final tariffs on Chinese exports to the US won't be anywhere near as high as 145%. However, duties won't be zero. Meanwhile, there's also some recovery when it comes to oil prices. Right, Shreyansi?
Well, absolutely. Some recovery is something that we saw coming in. In fact, to be very precise, a rise of more than $1 per barrel is what you saw coming in. You do have new US sanctions against Iran. Other than that, there's rising equity markets that also helped spark that recovery rally that we saw coming in from that prior session, steep sell-off, and it was quite a sell-off in the previous session. So when you take a look at the moves in the session gone by on Tuesday, you do have Brent crude futures that rose, like I mentioned, over $1 uptick coming in, 1.8% thereabout. Close around those $67 a barrel levels, and US WTI as well. Similar gains coming in, 1.5%. In fact, to the tune of about 2% uptick coming in for US WTI, $64 a barrel is where US WTI was at for most of the session. These were the kind of levels that you saw coming in as far as Brent and WTI were concerned. The United States, in fact, also has issued fresh sanctions when it comes to targeting an Iranian LPG and crude oil shipping magnate and his corporate network. You do have, despite Monday's recovery, still concerns persisting that US tariffs could be slashing global economic activity, also be weighing on demand. So that is definitely something that we're looking at in terms of factors for crude. Other than that, there's Russia's economy ministry that's also cut its forecast for the average price of Brent crude in 2025 by nearly 17% from its projection in September. So even that forecast is something that we're keeping a very close eye on, Kanishka.
Well, absolutely. Now, moving on, let's get you some global stories. Well, in what seems to be a drastic shift of stance, US President Donald Trump, as we told you earlier, has now expressed that he never had any intention of firing the Federal Reserve Chair before the end of his term next year. Now, since the start of the week, Trump has heaped pressure on Powell to cut interest rates under hopes of boosting macro growth. Now, Trump, in his most brutal criticism of the Fed chair, called Powell a major loser and urged him to lower rates immediately. But when asked on Tuesday afternoon about the prospect of firing Powell, Trump in fact said that the press runs away with things.
Rather than moving on, meanwhile, let's also put the spotlight on some commentary then coming in from key voices. Minneapolis Fed President Kashkari has said that the uncertainty around Trump's tariff policy is going to be leading to economic pullback and a possible recession at this point if there is no resolution. So that's some key commentary coming in there. Speaking at the US Chamber Global Summit as well, Kashkari spoke of the tariff math that now may entail purchasing goods abroad at a higher price. Additionally, also referred to a scenario where even a recession could hit the US if excess nervousness gets the consumers to spend lower and as a result trigger a macro slowdown. So while that was the word from the Fed, in fact, we also had Goldman Sachs' Robert Kaplan also speaking of the confidence that he has in the central bank to act in case of an economic downturn. However, he believes that Fed chair needs to anchor inflation expectations at this point. Additionally, also highlighted select structural changes at play in the United States, which include oil production as well as immigration.
Absolutely. Now, keeping it with the trade war space, Treasury Secretary of the US, Scott Bessent, has told investors in a closed-door meeting that he expects a de-escalation in Donald Trump's trade war with China in the very near future. In fact, he has even called the sky-high tariff fight between Washington and Beijing unsustainable. Bessent says that he believes the prospect of de-escalation between the economic superpowers should give the world, the markets, a sigh of relief. Now, equity markets in the US were seen staging a recovery since Bessent's remarks.
Well, absolutely, that's what we're looking at. But meanwhile, you do have the International Monetary Fund that has also cut its forecast for global growth, citing a major negative shock at this point from Trump's tariffs. In a stark assessment of the impact of the US president's policy, you do have IMF that also says that it expects that the sharp increases in both tariffs and uncertainty are going to be leading to a significant slowdown in the global growth in the near term. In fact, its forecasts also show that every major economy being hit, with the UK expected to grow by 1.1% when it comes to this year, down from 1.6% that was being penciled in January. The IMF, in fact, also expects a sharper deterioration when it comes to the US, from 2.7% to 1.8% among other economies. IMF, in fact, has also revised down its projection for India's economic growth in the current financial year to 6.2% from its earlier estimate of 6.5%, citing global uncertainties as well as trade tensions.
Important is what this means within a geopolitical context, because as that U.S.-India relationship grows, the economic relationships that had existed between the U.S. and China start migrating not just back home to the United States, but as we are already seeing, they migrate to India and help generate more and more economic activity to the benefit of the people of India.
Basically, the IMF forecast, if you look at it, it's not really penciled in the worst case scenario. They're still not forecasting a recession in the US. I think they've put the recession probability at around 37%. So in terms of impact on growth, especially for India, we have to also take into account that post April 9th, when Trump announced the 90-day pause, he's also announced exemptions, for example, on semiconductors, smartphones. If you take the total list of exemptions, for example, from when the bilateral tariffs were announced, as well as subsequently, for India, around 30% of US imports from India are exempted. If, let's say, the pause does not work and President Trump, post the pause, we go back to, let's say, 27% additional tariffs on India, then the growth impact can go up. It can go higher to maybe around 0.4 percentage points of GDP for India.
One is that India has always maintained that the partnership with the United States is a very consequential one. You would recall that, many years ago, not yesterday, not today, many years ago, Prime Minister Modi in 2016, while addressing the joint session of the US Congress, he had said, the India-US partnership is an indispensable partnership. Now, those are strong words. And even during President Joe Biden's term, we have heard both President Biden as well as Kurt Campbell, his White House expert, senior officer. He said, this is the most important relationship for the United States in the 21st century. So I think it is good to hear from Vice President J.D. Vance that he says that it is a very, very important relationship.
All right, then moving on, let's get you some updates on the earnings front. Well, Tesla, or the automaker, has reported a miss on the top and bottom lines in its first quarter earnings report, as the automotive revenue plunged 20% from a year earlier. Now, their total revenue slid 9% from $21.3 billion a year earlier. Now, automotive revenue too dropped 20% to $14 billion from $17.4 billion in the same period last year. Now, Tesla said that one reason for the decline was the need to update lines as its four-vehicle factories to start making a refreshed version of its popular Model Y SUV. The company also pointed towards lower average selling prices and sales incentives as a drag on the revenue and profit as well.
Alright, then time for a very quick break. More news and updates on the other side.
All right, then moving on, let's get you more updates on the earnings front. Well, HCL Tech reported inline set of numbers for the quarter gone by. Profit came in at about 6% lower compared to the last quarter, while revenue saw a marginal uptick of about 1%. For FY26, the tech major has said that it expects revenue growth of 2.5% on a year-on-year basis. Also, Ansh is joining in with all the number crunching.
HCL Tech has delivered steady set of numbers in line with our expectations. If we talk about revenue, then in dollar terms, it has gone down by around 1%. In CC terms, it is down by 0.8%, whereas in rupee terms, it has actually gone up by around 1.2%. Talking about profit, then that has come in at 4,307 crore, which is down by 6.2%. Especially if we talk about margin, then that has slipped from 19.5% directly to 18%. Whereas the total contract value has seen a good jump from $2,095 million directly to $2,995 million. If we talk about FY26 guidance, then company expects overall revenue growth to be in the range of 2 to 5%. Service revenue growth is also expected in same 2 to 5%, whereas EBIT margin is expected to stay between 18 to 19%, and this guidance is also broadly in line with our estimates. Lastly, if we talk about management, what they have said in press conference, then these are a few important lines. Pipeline continues to be around all-time high. Second, discretionary spending will continue to be subdued. Geopolitical factors are expected to impact IT services, but there will be strong growth opportunity emerging out of this market uncertainty. So overall, it was in line with the expectations, but management has given slightly cautious commentary here.
Well, absolutely. Thanks, Ansh, for getting that update coming in, then inline set of numbers with cautious commentary coming in from the management. Let's go across and listen in to what C. Vijay Kumar, CEO of HCL Tech, then had to say about their earnings as well as the outlook going forward, especially when it comes to AI then.
With respect to our pipeline, we are very pleased with the health of our pipeline. It continues to be near all-time high, even as we experience healthy conversions in Q4. The pipeline is supported by multiple deals across IT and business services, engineering services, and HCL software business. Looking ahead, we believe enterprises will accelerate AI adoption to enhance efficiencies and drive innovation. Generative AI has two facets. At the time of contract renewals, we expect both pricing pressures as well as new revenue opportunities. We believe discretionary spending will continue to be subdued in this environment. Geopolitical factors like tariff and deglobalization are expected to impact IT services. In the coming months, it will be an important topic to observe and monitor the ongoing development. As I look beyond the uncertain short term, I strongly believe there will be strong growth opportunities emerging out of the market uncertainty. Notably, AI and Gen AI are now integral components of almost every deal. Both Americas and Europe have shown considerable pipeline growth during the quarter. We've made significant strides in AI and Gen AI, impacting both clients and our internal operations and processes. Our four flagship offerings, AI Force, AI Foundry, AI Labs, AI Engineering, have seen substantial adoption and scaling in FY25. Our AI labs continue to enable clients in their AI journey. They've delivered 500 AI Gen AI engagements for 400 clients. HCL Software is also adopting AI Gen AI into various aspects of its business. And most importantly, we had several instances where we are winning higher wallet share with the existing customers as we bake in Gen AI-induced productivity gains in our bid.
Well, those are the kind of cues we are getting from HCL Tech as far as their FY26 guidance is concerned. Now, moving on, rate cuts are to help improve demand. That's the word coming in from Rami Kaushal, who's CBRE's Managing Director for Consulting and Valuation Services in India, Middle East and Africa. Let's listen into this conversation with ET Now's Anurag Shah.
2024, we've had a record year in real estate where all sectors, whether it was commercial, residential, retail or logistics, performed very, very well. Right, and we do not see a slowdown in the immediate term. So not only affordable, so we think with rate cuts, the affordability levels of real estate in general will go up, which should be a positive for the demand.
And so many panelists were saying about the land cost and overall cost has gone up. So going ahead also, do you think that overall cost in real estate projects will go up?
See, land cost is one of the constituents of the overall real estate development framework and the cost. Affordable housing will move towards outer areas of the city where the land is more affordable, because in affordable housing you want to provide a certain category of home at a certain price.
All right, then moving on, in its latest bulletin, RBI in fact has said that India's domestic consumption and investment sentiment is less susceptible to external headwinds. The central bank also reiterated that India remains a preferable investment destination in the face of global uncertainties. Anjali Palod is joining us with all the key takeaways. Anjali, over to you.
The Reserve Bank of India has come out with its bulletin for the month of April, and the RBI has noted that there will be a deleterious impact of escalating trade tensions on global growth. That is inevitable, and India's economic growth could also be impacted through weaker external demand. There could also be a potential pass-through of tariffs to consumer prices, and that could keep the inflation levels elevated. However, the RBI did note that domestic growth engines of consumption and investments are relatively less susceptible to external headwinds, and therefore India's domestic consumption and investment is likely to boost growth in the country. Prospects for the farm sector were boosted by the forecast of above normal southwest monsoon for the year 2025, and the inflation levels have also moderated to a 67-month low due to a moderation in food prices. For the month of March, India recorded headline inflation of 3.3%, and that was a 67-month low. So that is also a good sign. India has become a preferable investment destination also, and this is due to our position as the fastest growing major economy, as well as the macroeconomic stability that exists in the country. The RBI noted that there is continued positivity across sectors. Manufacturing is showing higher capacity utilization, and there is improved business sentiment in the sector. Services and infrastructure firms remain upbeat on demand, pricing and profitability. So those are the major takeaways from RBI's bulletin for the month of April.
All right, then moving on, RBI has also introduced exclusive internet domain for banks to combat online frauds and enhance public confidence in the digital banking and payment systems. Anjali is here with all the details.
With many customers falling prey to online frauds and scams, the RBI has now introduced an exclusive internet domain for banks in the country, which will be .bank.in, which means all legitimate websites from banks will have to carry the internet domain .bank and .in, which will make it much easier for customers to ascertain whether a certain website is legitimate or not. RBI has announced in a circular that by 31st October 2025, all banks will have to migrate to this new domain. In fact, the Institute for Development and Research in Banking Technology will be serving as the exclusive registrar for this domain, and the IDRBT will guide the banks on the application process, and the migration to new domain will be assisted by this institution. This initiative was announced in a statement by the RBI on 7th of February, and it is aimed at strengthening the cybersecurity framework and enhancing public confidence in digital banking and payment systems. Of late, many customers had been falling prey to illegitimate websites of banks because they look very much like the legitimate bank websites, but now with an exclusive domains, customers can browse or use the legitimate bank websites with much more confidence.
Well, absolutely. Thanks, Anjali, for that update coming in. Tell you what, let's shift the focus to earnings then. M&M Finance delivered its fourth quarter results. We do have Varun who's standing by to take stock of how the company fared in the quarter gone by. Varun?
Well, so the overall results of M&M Finance were a bit below our estimates. It was a soft quarter for M&M Finance, although the company, when it gave its quarter 4 updates, we were expecting a soft quarter, but the overall results have been below what we were expecting. Now, if you look at NII, it has come at around 1928 crores. We were expecting around 2078 crores. The pre-provisioning operating profit is up by only 3.4%. We were expecting it to come at around 1300 crores. It has come at 1,213 crores. Also, the profits, they are down by around 9%. The disbursement, they are up by around 2%, but if you look at segmental disbursements, for 3-wheelers, it is down by around 5%, and for pre-owned vehicles, the overall disbursement is down by around 11%. The company says that it has a better liquidity condition with the overall liquidity buffer of around 10,400 crores. But if you look at the overall results, the total operational expense, they have gone up by around 18%, and also the credit cost for the company has gone up, and that's the reason the net interest margin, which was expected to come at flat, they have actually declined by around 10 basis points. So overall, if you look, the results of M&M Finance are a slight below of what we were expecting.
Thank you, Varun, for getting us that review of Q4 results for M&M Finance. Now, moving on, clearing months of overhang, the government's safeguard duties will protect domestic steel industry, is what Steel Secretary Sandeep Pondrik said in an exclusive interview with ET Now. He also adds that the final call on the rate of import duty and the extension will be taken post DGTR's recommendations in August. Let's listen in.
Normally, it takes about 8 months for DGTR from the initiation of the investigation to give his final findings. So since the initiation, I think, was somewhere around January, we can expect the final findings somewhere around August of 25. And then in the meanwhile, DGTR will hear all stakeholders, industry and other stakeholders. So based on the final recommendations or final findings of DGTR, the government will take further decision either to modify, continue the duty. So that will be based on DGTR recommendations after the final findings are taken out by them.
Quite interesting. So I'm guessing that, like you said, there is a possibility that this 12% gets upped as well, right?
So I'm saying that DGTR will have a final, he will investigate further, come to a conclusion and give his recommendation. Based on that, government will take a decision either to modify or to continue. Because as you know, as per the notification, this duty can only go up to 200 days. So before that, DGTR will have to give his final findings so that government can take a further decision on the safeguard duties.
Sure. Other than duties, Mr. Pondrik, are there any other measures which are under consideration to try and support the domestic steel mills from the influx of cheap steel into the country?
There are already some anti-dumping duties in place, especially for stainless steel products, also for this electro-galvanized steel. So certain products, there are anti-dumping duty from certain countries like China, Vietnam, they are already in place. 2 investigations are being done by DGTR. One is, I think, from China for cold CRNO, what we call CRNO, cold rolled non-oriented steel, and the other is for hot rolled steel from Vietnam. So for both these investigations, DGTR has completed his hearing and he will give his recommendations to the government. I expect pretty soon. Then government will take a decision. So there are some measures already in place. Then there are some investigations and already under place. As you know that the industry has to approach DGTR when they apprehend certain kind of injury or dumping, and then there is a process. Apart from that, we are also ensuring that only quality steel comes into the country. Because what happens is that sometimes when the domestic industry is producing quality steel, there is always an apprehension that low quality steel may be imported at lower cost, which will eventually harm the domestic industry. So we are trying to bring all grades of steel which are used on a large scale into BIS standards in collaboration with BIS. And we are issuing quality control orders. So this is not a barrier, but this is a measure to ensure that non-quality steel or substandard steel doesn't come into the country.
All right, then moving on, amid uncertain and volatile times in the market, the only asset class that's managed to retain its sheen at this point is gold, of course. You do have gold that has gained over 27% thereabout on a year-to-date basis thus far this year. So you do have a slight pullback that we saw coming in. So amid the record peaks, is there merit in exercising some caution? Is a correction then in sight over the near term? Listen in to what the experts had to say.
I think gold could have a big correction at any time, but I think gold will be higher in a year's time. I would advise people with long positions in gold to continue to hold and just take profits at the margin. Obviously, if you own gold on leverage, you should take some profits, but gold's trading very well.
So what we were trying to say with the gold long was that, bad behavior has its consequences, and people start to lose faith, especially in the currencies that central banks and governments are printing, paper money. So it was time to be much, much more aligned with the old-fashioned currency, the one that doesn't get printed out of existence, and that's gold.
I own gold and silver, and I bought more silver recently. Silver's still depressed. Those are two of the few. Well, I'm not buying gold because it's making highs. I hope I never sell my gold. I hope that my children own my gold someday. I am not selling my gold, even though it's making all-time highs.
Gold is extremely expensive in any metric. Of course, you guys all putting out this charts that, Nifty has, of course, underperformed gold for last couple of 2 decades at least. So very, very expensive for a zero coupon infinite bond. It's very expensive. From an allocation point of view, it's time to be sort of super concerned about gold valuations now. So I don't think it's a time to dial up gold in any meaningful fashion.
Gold is up almost 50% in the last 1 year, despite the correction that we are seeing. You can't have an asset class keep going up, one way. I'm a big bull on gold, but I'm saying that it's gone up too fast, too soon. So there will be some correction, but over a period of time, I'm still bullish on gold that this is an asset class which will do well, but it can't go up 50% every year.
Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar and Shreyansi Singh. Well, as we promised you earlier, we'll get you a list of stocks to keep on your radar today. We are hoping for a gap up opening this morning. My colleague Gaurav is standing by with the list of all the stocks to keep on your radar as we head into the trading session today. Gaurav, good morning.
Yes, good morning. So first let's talk about EU Small Finance Bank, because weak set of number is what we saw for Q4 when we talk about net profitability that declined almost by 5% on a sequential basis. And on the other hand, when we talk about credit cost, that increased almost to 14% in the MFI segment and 16% in the credit card segment. So definitely on the back of the asset quality issues, and net interest margins also fell by 6 basis points. Definitely we're watching out on this bank. Other than that, Havells is going to be in focus because company reported good set of numbers. Revenue increased almost by 20% on a sequential basis, while net profitability almost increased by 16% on a sequential basis. Other than that, Tata Communication is also going to be in focus because weak set of number is what we saw. When we look at EBITDA margin, we saw EBITDA margins decline almost by 164 basis points on a sequential basis. And on the other hand, profitability actually increased almost 3 folds, but there was a one-off impact, and that is the reason why this stock is going to be in focus. Other than that, Bharti Airtel is in focus because Airtel is going to acquire 400 megahertz of spectrum in the 26 gigahertz band from Adani Data Network Limited. IndusInd Bank is also going to be in focus because yesterday there were news reports which suggested that financial audit is going on from the external auditor, but now the bank has clarified that internal audit department is actually conducting a review in the MFI segment as a part of process of finalizing the numbers, but definitely no external auditor is involved in this process. The Ashoka Buildcon is also going to be in focus because company has received an LOA from Central Rail project, and the value of this project is around 560 crore rupees. Varun Beverages actually started its new plant. They have started commercial production at for the carbonated soft drinks, juice-based drinks in one of their plants in Uttar Pradesh, and as a result, this company is going to be in focus. And lastly, let's also focus on Ambuja Cement, because management has now approved execution of share purchase agreement of Orient Cement. Company is going to submit the open offer for 26% stake of the company for 395 rupees per share. So definitely watching out on all these stocks on the back of the news flow that were received in the morning.
All right, thanks Gaurav for getting us that update. So there you have it. That's the list of stocks that you should be keeping on your radar bright and early this morning. Tell you what, let's move on. FMCG major Tata Consumer is all set to report its Q4 results today. Let's go across to Snehi to understand what the street is penciling in. Snehi, looks like a muted set is in store.
Absolutely. So muted set is what we're expecting from Tata Consumers this time around, much like its previous quarter's numbers. Let's take a look on a consolidated year-on-year basis. Revenue is expected at 4,555 crores compared to 3,927 crores, which is an uptick of 16%. So this is largely in line with what the previous quarter's performance was as well. Now, if you take a look at EBITDA, that's seen at 612 crores versus 630 crores this time last year, which is a downfall of roughly 3% on a year-on-year basis. Now, the catch is in the net profit. Let's understand what we can expect on the net profit front. Now remember, in quarter four of FY24, there was an adjustment. There was an exceptional loss of 216 odd crores on account of an asset write down and acquisition cost. So if you account for that cost in last year's profit, then that reported PAT is at 216 crores for last year, and what we are seeing this year is 322 crores. So on the reported basis, that number is up 49% on a year-on-year basis. However, ideally how you should be looking at this is the adjusted PAT, which means if you don't account for that loss, then 432 crores is the profit last year, and this time we're seeing 322, which means it's a downtick of 25.5%. So however, on a reported basis, this number might seem quite attractive. On an actual adjusted basis, we're expecting a cut of 25.5% on the net profit front. EBITDA margin expected at 13.4% compared to 16%, a downtick here as well. Now, what we are expecting largely, let's talk about the tea business. India tea price hikes are lagging the raw material inflation that they have seen. Hence, this is something that could weigh on EBITDA and margins. Tea domestic volume expected at 5% and value growth of 11% on a year-on-year basis. Salt is expected to do well on the back of price hikes. So 11% year-on-year growth is what we're expecting. A 14.5% year-on-year organic growth in India foods business versus 11% in quarter 3. So India foods is expected to do quite okay. Food inflation has remained stable sequentially. However, on a year-on-year basis, it still remains elevated, and this could affect overall numbers as well. Nourishco is expected to post sequential improvement in volume, Sampann to grow by 25%, and high single-digit growth is what we're seeing in the international branded business as well. On the flip side, Capital Food and Organic India are expected to report flat revenue on a sequential basis. Finally, when the numbers come out, update on growth business, Starbucks, margin outlook, and raw material inflation are going to be key factors to watch out for.
Thank you, Snehi, for getting us all those updates and the cues to watch out for when it comes to Tata Consumer Q4 results. Now, moving on. Well, this is a good time for bottom-up stock picking, is what Gautam Duggar, Head of Research at Institutional Equities, Motilal Oswal believes. Listen in to what else he had to say about his top sectoral picks as well as his take on the tariff situation.
The situation is such that you cannot take a very long-term call on this unfolding tariff measures. You know, every alternate day you hear something different. So it will be very foolhardy to form a very rigid view on whether this thing is over or not. As an investor, all you can try and do is try to ensure that the damage to your portfolio is as low as possible. I know that's very difficult to do in this kind of an environment, but the macro situation of India is quite strong right now. You know, and with RBI also turning very supportive of the growth in the last 3-4 months, a lot of the pieces which had impacted our performance in FY25, and incidentally, we are coming to a close of FY25 with a very flattish year. In fact, the EPS has not moved much, 1 or 2% for FY25 and Nifty. And in the last 2-3 months, you've seen the domestic macros turning a bit more supportive for growth. And in between came this whole global headwinds. Now, it's very easy to get swayed by what is happening around you, but there's very little you can do about it. So just hope that the damage to your portfolio is limited. The kind of exposure that you have in your portfolio should be such that in the worst case, at least the relative damage from a sector point of view, from a bottoms-up point of view, should be as limited as possible. That's the approach we have taken in our portfolio, while remaining cognizant to the risk which is emerging every alternate day on a new front. For now, we've seen that market has recouped the losses that stemmed post the 2nd April tariff announcements. And Nikunj, if you stretch back a little, we had already fallen before this whole tariff saga started unfolding. And obviously, one of the prime reasons for our fall was the sagging growth and a very muted corporate earnings. Last 4 years have been terrific. I mean, if you were told that 20 to 2024, you've seen a 25-26% earnings CAGR across all cohorts, it's very difficult to believe in today's environment. But that's how